Something extraordinary just happened in the global metals market, and almost no one in mainstream finance wants to talk about it. On Friday morning, the London Metal Exchange delayed the start of trading due to what it described as a technical issue. According to reports seen by Bloomberg, the LME's electronic trading platform was paused for nearly an hour while the issue was investigated, with trading finally resuming later in the session. Officially, we're told there's nothing to see here. But when the world's most important pricing venue for industrial and monetary metals suddenly cannot open on time, during a period of record volatility and historic price moves, investors are right to ask a much harder question. What exactly failed? And more importantly, what is the LME not telling us? This delay did not occur in a vacuum. It came immediately after one of the most violent episodes of price manipulation ever recorded in financial history. Within a single trading day, nearly $3 trillion in paper value was erased from gold and silver, only for $2.5 trillion to be added back hours later. These back-to-back moves now rank as the largest liquidity events ever recorded in any market, not just metals, but across all of human financial history. This was not normal volatility. This was not price discovery. This was an emergency intervention. During the final hours of U.S. trading, the silver paper market was hit with an avalanche of synthetic supply. Roughly 40 million ounces worth of contracts were dumped within minutes, overwhelming liquidity and forcing prices sharply lower, briefly. Yet even that failed. Prices stabilized. Buyers stepped in, and by the end of the session, much of the damage had already been reversed. This pattern is becoming familiar because we've seen it before. In November 2025, a cooling system failure at a major U.S. data center forced the shutdown of nearly 90% of global derivatives trading, crippling CME Group systems and exposing a dangerous vulnerability in the financial infrastructure itself. Not cyber warfare, not hacking, something far more basic. Physical limitations, cooling capacity, power constraints, infrastructure stress. The illusion that modern markets are infinitely liquid and infinitely stable is beginning to crack, and precious metals are where those cracks are appearing first. Despite increasingly aggressive interventions, gold and silver have continued climbing steadily into 2026. And according to some of the most experienced analysts in the sector, this bull market is not late. It is early. The forces driving it, sovereign debt expansion, currency debasement, geopolitical fragmentation, and the slow collapse of confidence in fiat systems, are far larger than the short-term maneuvering of bullion banks or exchange operators. In today's video, we bring together two veteran voices who approach the market from very different angles, yet arrive at the same conclusion. Peter Schiff and Michael Oliver have spent decades studying monetary cycles, debt structures, and long-term price behavior. And both are warning that what we are witnessing now is not speculation. It is repricing. Before we get into their analysis, take a moment to support the channel. Like the video, subscribe if you haven't already, and share this with anyone trying to understand what's really happening beneath the surface of the metals market. And make sure you watch all the way through, because the second half of this discussion may completely change how you think about silver's role in the coming months.
This is a complete repricing of gold and silver for the new monetary world order. I think what's happening is central banks are moving out of dollars and into gold so that the primary reserve asset backing up currencies is going to be gold, as it should be. So the dollar's days of being the reserve currency and the exorbitant privilege that went along with it are coming to an end. And that is a game changer for the United States. It means our days of living, high on the hog and riding the global gravy train are over. We can't live beyond our means anymore. We can't consume unless we produce. We can't borrow unless we save. And that means our entire economy that's been built on these trade deficits and leverage and consumer credit, it's all going to implode. This is going to be a massive economic collapse. This is a crisis much bigger than the '08 financial crisis for America. It's not going to be global. It's going to be a U.S. crisis. It's going to be a U.S. dollar and a U.S. sovereign debt crisis. That's actually a positive for the rest of the world because the purchasing power that Americans lose, the rest of the world gains. The world is going to reclaim their productivity. The rest of the world is going to have more goods to consume and more capital to invest. They're not going to be sending their goods here and loaning their capital to us. They're going to be investing their capital domestically and consuming their own production. So their standard of living is going to go up. The standard of living in America is going to go down. And a lot of investors who aren't positioned for this outcome are going to see a tremendous loss in the real value of their stock and bond portfolios. That's why they need to also divest. It's not just foreign central banks now that are buying a gold and silver. Private investors are just starting to move into the market. They have a long way to go, but a lot of investors are still very, cautious about this move. They don't really understand it. Some people think it's a bubble. They expect the price of gold and silver to come back down. Of course, they never expected it to go up. And that's why they're not only reluctant to buy, but they're reluctant to buy the gold and silver mining stocks that are arguably the cheapest they've ever been. Even though these stocks have tripled or quadrupled, they're cheaper now than before they tripled or quadrupled because their earnings have gone up much more than the share price, because investors don't believe the earnings are sustainable because they expect the price of gold to come way down. But not only are they wrong to think that gold and silver prices are going to come crashing back down, they're actually going to keep rising. So a year from now, gold is going to be more expensive than it is right now. The same thing for silver. So at some point, investors are going to come to terms with this reality, and these stocks are going to go through the roof. But for now, you still have a second bite at the apple to buy them. If you didn't buy them before they tripled, you could still buy them before they triple again and more. And really, too, what I think gold and silver are doing today, they're doing what subprime did in 2007. Subprime collapse was the warning that the financial crisis was coming. It hit the following year. Gold and silver breaking out is a similar warning that the sovereign debt and dollar crisis are going to hit. And they might hit even this year. But I would say either this year or next year.
What is this, emerging world order, if you want to call it that? What does this look like?
Yeah, it's the world where, the U.S. really occupies the center, where the dollar is the lifeblood of the economy and everybody wants dollars and we get to print them and we get to have this service sector economy where we consume what everybody else produces and we borrow the money that everybody saves and we get, the easy part and the rest of the world does the hard stuff. That's coming to an end. I mean, and Donald Trump actually agitated to bring it to an end sooner because he doesn't understand it. See, Donald Trump looks at the global economy and thinks that we are the drivers because we buy everything. He doesn't understand that that's the easy part. Anybody can consume. The hard part is the production. And anybody who can produce can, by definition, consume what they've produced. But what you can't do is consume what you haven't produced. So if you separate America from the rest of the world doesn't have a problem. They have a lot of goods that they produced. All they have to do is consume them. America, on the other hand, doesn't have the goods. So what are we going to do, right? We just have empty shelves and sky-high prices. The rest of the world has full shelves and lower prices. Who's in a better position? Look, when you have a mania, right, it is driven by greed. What we see now in the precious metals market is fear that the market's going to drop. So investors are approaching the sector with a high degree of caution. In a mania, in a bubble, you throw caution to the wind, right? Who cares? In a mania, stocks get expensive and people look for ways to justify the high prices, right? The PEs go up. Gold stocks have gotten cheaper. Their PEs have gone down. Their price to cash flow has gone down. And so people are justifying why gold stocks are not really worth what they're worth, right? So when we are finally in the blow-off bubble stage of the gold bull market, and who knows how long it's going to last, you're going to see crazy valuations assigned to gold mining companies. In fact, you're probably going to see companies that don't even have gold become gold companies, right? Like during the dot-com bubble, right? A lot of companies just started adding .com to their name, right? So they would get a pop. And, during this crypto bubble, a lot of companies decided to become Bitcoin treasury companies. They said, we have a crypto strategy, right? So what's going to happen during the gold bull market? Eventually, companies are going to become gold companies, right? Just to get in on it, just to get some of the money that's going to be pouring indiscriminately into the sector, right? And everybody's going to be buying.
Peter Schiff's message is blunt and deeply uncomfortable for anyone still anchored to the old financial order. He argues that gold and silver are not rising because of inflation headlines or speculative enthusiasm. They are rising because the world is quietly preparing for a different monetary structure altogether. Central banks are reducing their exposure to US dollars and increasing their allocation to gold, not as a trade, but as a reserve asset. In Schiff's view, this marks the beginning of the end for the dollar's role as the unquestioned foundation of the global system. For decades, the United States benefited from what economists called exorbitant privilege, the ability to consume far more than it produced, borrow endlessly, and finance deficits simply by issuing currency the rest of the world was forced to hold. That arrangement, Schiff argues, is now unraveling. As the dollar's dominance fades, the consequences will not be evenly distributed. This will not be a global financial crisis in the traditional sense. It will be a U.S. sovereign debt and currency crisis, with purchasing power shifting away from American consumers and back toward the producing nations of the world. In his view, gold and silver today are sending the same warning signal that subprime mortgages sent in 2007. Not the crisis itself, but the unmistakable early tremor that something far larger is coming. What makes Schiff's argument especially compelling is that it aligns almost perfectly with what the technical data is showing, even though it comes from a completely different discipline. Schiff approaches this from a monetary and macroeconomic perspective. Michael Oliver approaches it through long-term market structure, historical ratios, and momentum behavior. Yet both are describing the same phenomenon, a structural repricing of gold and silver driven not by speculation, but by systemic stress. And when Oliver turns his attention to silver specifically, the implications become even more dramatic, with projections that challenge almost every assumption investors still hold about what is possible.
If you go back and look historically at gold since it was legalized in the U.S., you've had two prior bull markets. One came from the 1976 low to the 1980 high. And if you look at that carefully, it was an 8-fold move. In other words, if you bought gold, you made 8 times your money in 3.5 years. Okay. Then it corrected and lived in a new higher universe for a couple decades. And then in 2002, it made a low at $265. And over the next 10 years, it went up 8-fold move. You bought the bear low, you made 8 times your money. Different dimension in time, but same multiple. Well, our bear market low was 1,050 in December of 2015. And where are we now? 5-fold. We're not even 8-fold yet. In other words, gold has yet to do in metrics, ratio, scale, move, what it's already done twice before. You'd have to go to $8,500 gold. And then when you get there, you'd say, well, it's got to be it's only matching the bull trends that it had before in terms of dimensionality. So that would be a norm. So you say, where's gold going? I'd say, if it goes to a norm, it'll go to 8,500. But we're in a different world this time. This time we have a government debt crisis. And I don't know where it's going. But the world is changing. And that crisis, which will also involve a stock market decline, will create changes in the world that we've not expected, particularly government and money. So if we've had like 100 years of fiat currency and Federal Reserves and central banks printing the stuff like crazy and controlling the price and quantity of money, effectively a collectivist notion of how to control money, and it doesn't work, then people are going to say, well, this isn't working. Academicians will say, I kind of like the idea, but it really hasn't worked. So when you get into this next crisis, you're going to have a lot of things change, including, I suspect, you won't even have a Fed in a year or two. Well, simply because, hey, it's dysfunctional, okay? It hasn't solved any problems. In fact, you look at Fed funds rate chart, and they've been printing money since 2009. Either it's been at 0 or got up to 5, but even that, the interest rate level, is in the bottom quadrant of the past 75 years of rates. So it's been free money. And so the stock market went up. Once things start to break, that's when people start questioning, maybe we need gold-backed money again. Chinese are thinking about it. I think Indians are even looking at silver. When you get into this crisis, there's going to be a rethink. So when you say, where's gold going? I don't know.
Yeah.
Except it's probably going well beyond the norm. And it's probably going to do a lot of it, our assessment, and this is based on some multiple factors. A lot of it's going to occur dramatically between now and summer, particularly in the case of silver.
When you give silver a timeline of 4 months or this summer, what are you looking at that tells you 4 months?
There's a factor that we've been watching, multiple factors that coalesce and tell us that we've entered a phase in silver similar to, or almost identical to, the surge that occurred in 79 to 80 and already in a bull market for multiple years, but suddenly in the final 5 months of that, silver quadrupled, went berserk. Okay, 5 months, just short of 2 quarters. And you go back and look at 2010, in September of 2010, something happened. I'll tell you what it was, technical thing. And in the next 7 months, silver doubled and a half. It was like $20, it went to 50. Okay, but all of a sudden in the latter phase of ongoing bull markets, it wasn't like a new bull market. It just went berserk. Okay, but both of those berserk moves were within that old half-century range where silver was capped off. Gold wasn't capped off during that time, but silver was. Same highs. 1980 and 2011, same high, whereas gold was, way above the 1980 high. Okay, for some reason, silver was capped. Silver just recently made a statement, said, okay, I'm going to break out of the old antique range. And I'm going to overcome the distribution by the banks. I'm in charge now. There's a reality bigger than that. And I'm going to get to the new reality. I'm going to reprice myself relative to gold more normally. It's been very repressed in price versus gold. It's been very cheap in relation to commodities. It's been very cheap so many metrics say that silver was priced off the page artificially or what. Okay, it's going to correct for that. When those spreads of silver measured versus gold, where you take an ounce of silver and divide it into an ounce of gold, what percent is silver? Well, back in that 1980 surge, where silver went berserk for 5 months, quadrupled in 5 months, the spread of silver versus gold was up at 6.5%. Okay, remember that. Then in the next price surge, still within that old antique range, $50 highs, 2010 and 11, the spread also broke out where you could plot silver versus gold on a chart and you could see a ceiling. And when it broke through that, in 2 quarters, silver went berserk. 7 months in this case. One was 5 months, one was 7. But basically 2 quarters, it did its thing in a tantrum. But it was still confined in that range. Silver had a more even massive technical range. If you simply don't look at the price of silver or gold, just divide one into the other and plot it each month close. You had this 10-year ceiling. You just broke through it in November. So you start with December. Okay, 1 month, 2 months. Okay, we're only 2 months into this orgy, and people are stunned by what you're seeing here. They say, "Oh my gosh, that's got to be the end of it." That clock says, give it a couple quarters. Don't assume. And silver still is only 2+% the price of gold, so it's still dirt cheap relative to gold. It's probably going to 3 to 6% the price of gold. Well, you do the math. Gold only matches the prior bull market peaks of 8-fold gains and goes to 8,500, let's say. And you figure out what more than 3% of that is, or what 6.5 is. It'll put you silver up a couple hundred, $250 to 500.
For over half a century, silver traded within a rigid price ceiling, repeatedly capped despite rising inflation, rising industrial demand, and expanding money supply. That suppression distorted its relationship to gold, commodities, and real purchasing power. That ceiling has now been broken. When silver broke out of its long-term ratio structure against gold, it triggered a pattern that has historically preceded its most violent advances. In previous cycles, once these ratios gave way, silver entered brief but extreme phases, doubling, tripling, or quadrupling within a matter of months. Oliver argues that the same setup is now in place. Only this time, the breakout is occurring from a far larger and more distorted base. Measured historically, silver remains extraordinarily cheap relative to gold. And as that relationship normalizes, the implied price targets expand rapidly. When silver trades at just 3 to 6% of gold's price, levels seen during prior surges, and gold itself advances toward long-term norms, the math becomes unavoidable. $200, $300, even $500 per ounce. Oliver reinforces this case using logarithmic price structures rather than simple arithmetic charts. When silver's 50-year trading range is projected forward using ratio scaling, the same method gold has followed, the technical target aligns near $500. Monetary expansion tells the same story. Adjusting silver's 1980 peak for growth in money supply alone produces a remarkably similar figure. In Oliver's view, silver is not entering a bubble. It is escaping one, a suppression bubble that lasted far too long. And when markets finally correct distortions of that magnitude, they do not do so gently. They tend to overshoot. While Western exchanges struggle with outages, delays, and increasingly aggressive paper interventions, the physical market is sending a very different signal. In Shanghai, silver premiums have surged beyond $25 per ounce, with spot prices trading far above Western benchmarks. Indian physical silver prices have reached approximately $186 per ounce, with widespread reports of bar shortages and limited availability. This divergence is critical. It shows that price suppression exists primarily within Western paper markets, not in regions where metals are bought for delivery, not leverage. The East is not trading silver as a derivative. It is accumulating it as a strategic asset. And that gap between paper price and physical reality cannot remain open indefinitely. What we are witnessing is not random volatility, not speculative frenzy, and not a temporary dislocation. It is the slow failure of an old system colliding with the emergence of a new one. Peter Schiff explains why the monetary foundation is cracking. Michael Oliver shows what happens when decades of suppression finally unwind. Different approaches. Send conclusion. Gold is being repriced for a new monetary world. Silver is being pulled violently toward a reality it was denied for decades. And once that process accelerates, it rarely offers second chances. If you found this breakdown valuable, make sure you like the video, share it with fellow investors, and subscribe to stay ahead of what's unfolding. Drop your thoughts in the comments, especially on whether you believe the West can maintain control of paper pricing as physical demand continues shifting east. Thanks for watching, and stay alert.